All right, let's dive right into this explainer and unpack what is frankly a fascinating financial mystery behind Broadstone Net Lease. We are looking at a real estate investment trust that has Wall Street completely divided right now. Because, on one hand, you've got these sky-high margins. But on the other hand, the underlying metrics are absolutely screaming danger. So let's figure out exactly what is going on with this stock.
Right out of the gate, we're confronted with this number, 5.51%. This is the highly attractive dividend yield that's currently drawing yield-hungry investors in like a magnet. And hey, in a typical environment, a yield this solid from a commercial real estate portfolio is exactly what you want to see. But it hides a much harsher reality, because despite this generous payout, the stock itself is down over 22.5% year-to-date. And keep in mind, this is happening while the broader S&P 500 market is rallying by over 13%. When you've got a stock paying out over 5% but losing nearly a quarter of its value in the middle of a bull market, you literally have a serious paradox on your hands.
So, to make sense of all this, here's our roadmap for today. We'll start with the paradox, uncover 7 hidden green flags, expose 7 warning red flags, stress test it against the investment legends, and finally, deliver the final verdict.
Okay, Section 1, the Broadstone Net Lease Paradox.
So Broadstone Net Lease is a $4 billion market cap net lease REIT. They operate a really diversified portfolio of single-tenant properties. We're talking industrial, healthcare, restaurants, retail, and office sectors. Now, recently, they completed an 11 million share public offering priced at $20.50. And today, the stock is trading right around that exact same level at $20.46. So the market has essentially pinned the current value exactly to this recent capital raise.
Moving right along to Section 2, 7 hidden green flags.
This company has immense professional validation. A staggering 89.07% of outstanding shares are held by institutional investors. We are talking about the absolute heavyweights here. BlackRock holds nearly 17%, Vanguard holds over 9%. In fact, over a recent 12-month period, 213 institutional buyers poured money into this stock. That created a net inflow of $480 million. And that kind of backing provides some really significant price support.
And honestly, they're likely buying in because of the powerful momentum we're seeing right here. In their latest quarter, BNL reported net income growth of over 47%, with quarterly earnings growth year over year jumping by an incredible 97.4%. But what's really wild is they pair that aggressive growth with a beta of 0.61 to 0.95. For those who track beta, the lower end of that spectrum means this stock is up to 39% less volatile than the broader market. So you're basically getting this aggressive earnings momentum inside a vehicle that is historically much less turbulent than the S&P 500.
Rounding out the green flags, we see a business with some serious operational muscle. Their operating margin is a jaw-dropping 46.19%. That indicates immense pricing power. Plus, Guru Focus gives them a solid overall performance score and a narrow moat, which is heavily thanks to their build-to-suit platform acting as a major competitive advantage. Because of all this, it is really no surprise that 11 analysts polled by S&P Global have a consensus buy rating on the stock, with price targets reaching up to $26. That implies a potential upside of up to 27%. Look, if we stop this explainer right here, you'd probably think this was a total no-brainer investment.
But hold on a second. Section 3, 7 warning red flags.
You remember that beautiful 5.51% dividend yield we started with? Well, here's the cost of it. This is a dangerously high dividend payout ratio. Right now, BNL is paying out between 172% and 180% of its earnings. Let me be perfectly clear about what that means. The company is paying out significantly more in dividends than it actually earns in net income. Actually, to put a finer point on it, their free cash flow payout ratio is sitting at exactly 100%. This is generally considered completely unsustainable over the long term. It heavily implies they might be relying on external financing or maybe even asset sales just to keep sending those dividend checks out to investors.
And this brilliantly illustrates the core paradox of BNL's financials. On one side, you have these highly exceptional operating margins of over 46%. They are incredibly efficient at their core business operations. But on the other side, their return on invested capital, or ROIC, is a dismal 4.13%. Now, why does that matter? Because the company's weighted average cost of capital is 7.14%. So it literally costs them over 7% to access capital, but they only generate a 4% return when they invest it. Despite those massive high margins, they are actively destroying shareholder value every single time they allocate capital.
And the bear case just rapidly solidifies when you look at these remaining metrics. The stock is currently overvalued by 14% to almost 29% based on its intrinsic GF value. Insiders, they barely own any of the company, just 1.02%, meaning management has very little skin in the game. On top of that, it's saddled with $2.69 billion in debt, which leaves a dangerously thin interest coverage ratio in our current high-rate environment. And smart money definitely knows this. Short interest has been climbing and is now sitting at 6.53% of the float. Plus, you're paying a hefty premium of 27.54 times earnings for a stock that's severely trailing the overall market.
So, let's put it to the test. Section 4. Testing the investment legends. The consensus among the absolute legends of investing is largely rejective here. Benjamin Graham, the father of value investing, gives it a hard pass. He demanded PE ratios under 15, and as we saw, BNL is sitting way up at 27.54. Peter Lynch, he might give it a mixed glance. I mean, he'd love that 45.9% growth rate, for sure, but he'd hate that the PE exceeds his ideal parameters. And Warren Buffett? He requires companies to generate at least a 15% return on invested capital. BNL's abysmal 4.13% ROIC means Buffett wouldn't even give this a second look. The low returns on capital just completely neutralize their otherwise solid economic moat.
All right, it's time to bring it all together. Section 5, the final verdict.
Depending on your personal strategy, here is exactly how to approach this one. If you're a pure value or contrarian investor, you should probably just walk away entirely. The numbers show a 14 to 28% overvaluation, and those low returns on capital are just a deal breaker. However, if you are a dedicated REIT investor or an income investor, BNL shouldn't necessarily be thrown out just yet. You might want to add this to a watch list or consider it with extreme caution. That 5.51% yield is undeniably attractive in today's market, and the underlying real estate portfolio really is genuinely high quality. But you absolutely must carefully monitor that debt and those payout ratios.
Which brings us to the ultimate question you have to ask yourself before putting a single dollar into this company. Can they actually sustain this dividend? To pull it off, management has to drastically improve their return on invested capital so they actually start creating value rather than destroying it. And they've got to do this while managing $2.69 billion in debt. All of this before that nearly 180% unsustainable payout ratio catches up to them and forces a really painful dividend cut.
We will leave you with this classic reminder from Warren Buffett. At the current price of $20.46, you are paying a distinct premium for fundamentally questionable economics. You're paying for a 172% payout ratio and a 4% ROIC. If you love the diversified properties and you love the institutional backing, the smart move here is likely patience. Consider waiting for a pullback toward that $17 to $18 intrinsic value range, or at least until management proves they can sustainably cover their dividend before committing your capital. That wraps up our deep dive into the Broadstone Net Lease paradox. But we want to know what you think. Is this 5.5% yield a hidden gem just waiting for a turnaround, or is it a classic value trap ready to spring? Let us know your verdict down in the comments. Thank you so much for learning with us today, and we'll see you in the next explainer.